BFM Crash Course के यूनिट 14 में आपका स्वागत है. So we are discussing market risk, which is unit 14. So first of all, let's go through this particular slide. Everything about trading book is just covered in one single slide. Let's go through. So what is trading book? You can think of it as a special portfolio that hold asset a bank intend to trade frequently. Right. So those assets which bank intend to trade frequently, these are included in trading book, and all for short term profit. Right. Everything for short term profit that bank intend to trade frequently for short term profit. So these are included in the trading book. So what are the core component of the trading book? As you can see, debt security, right, equities, foreign exchange, derivative and commodities. So these are the go-to instrument when bank aim to make profit from the market movement. If you look at the trading intent on the right hand side, you can see what is the trading intent. So the intent behind the trading book is to capture short term gain. The main intent behind the trading book is to capture what? Capture the short term profit. It's all about profiting from the price difference between what is expected and what actually happened. It also includes some hedging activity, right? So that is called trading intent. It's all about profiting from price difference. What is expected, what actually happened. It also includes some hedging activity. That is called the trading intent. What are the risk involved? Let's see the risk involved here. Yes, very important. Trading book, what kind of risk involved? The first risk is called market risk, which fluctuation in the rate or forex can affect the value. Then the second risk called liquidity risk. There might be delay in buying, there might be delay in selling. Then the third risk is called asset liquidity risk, because these kinds of core components are there. So for every instrument, risk are also involved. Asset liquidity risk means some assets are simply hard to sell. You can't sell some kind of asset. And market liquidity risk. What if there is no buyer in the market? That is called market liquidity risk. Then we have credit or counterparty risk, which means default or downgrade can shake the things up. So remember, question can be asked, which of the following risk can be is a part of trading book? So remember, market risk is there, liquidity risk is there, credit risk is there, operational risk is not there, asset liquidity risk is there, market liquidity risk is there. So I hope it is clear now. Additional consideration, as you can see, so don't forget, market risk also include unexpected loss due to high volatility, which directly hit earning and capital. So the trading book is all about a strategic short term play, but bank need to stay sharp because risk and reward goes in hand. Now friends, let's come to the next slide. That is, we have understanding trading liquidity and the associated risk. Very important. So let's dive into one of the crucial aspect of financial market, that is called trading liquidity, and why it is a big deal when it comes to the trading risk. First of all, what is the meaning of this trading liquidity? See, at its core, trading liquidity means easy to trade at fair price with no big price impact, right? So it means trading liquidity means what? Means that easy to trade, you can trade easily, fair price it have, right? So you can see price, fair price is that with no big price impact, right, without drawing too much attention, and with safe quality counterparty, right? That is called trading liquidity. In short, it is a smooth experience that every trader hope for. But what happens when liquidity dries up? That is the consequence of liquidity. So you can see now, easy trade plus fair price plus no price impact plus no attention plus counterparty quality safe, right? So with no big price impact, without drawing too much attention. But what happens when liquidity dries up? You can see, first of all, imagine this: price is falling suddenly, you can't sell at fair price, you are forced to sell at loss, right? And worst of all, no one is buying. So that is called liquidation risk in action. It is a nightmare of every trading desk. This liquidation risk is a kind of nightmare. So these are the consequences of liquidation risk. If you look at the type of liquidation risk, we have two types: asset liquidity, which means asset itself is very hard to sell even though the market is functioning, and the market liquidity, which means the entire market dries up, no activity, no trading, totally freeze. So these are the two kinds of liquidity risk we have. Asset liquidity means asset is hard to sell, right? And market liquidity, which means the entire market dries up, no activity, no trade. Then let's see the risk involved. So liquidation risk is a sum of two kind of risk: asset risk plus market liquidity risk, right? So it is a perfect storm. And remember, the lower the liquidity, the higher the price volatility. So I try to understand, very important. Liquidation risk is the kind, it includes two things: asset risk plus market liquidity risk. Suppose liquidity is high. Suppose high liquidity, it means price will stay stable. If there is a low liquidity, then price will swing wildly. That is called adverse movement in the price. So basically, two things are added to get liquidation risk: asset risk plus market liquidity risk. And perfect storm, and lower the liquidity, the higher the price volatility, right? If higher liquidity is there, it means a stable price stays stable, and low liquidity means price will swing widely. So liquidity and price volatility, they are inversely proportional, as you can see it here, right? Now friends, let's look at market risk versus market liquidity risk. What is the difference? Here you can see very very important. Market risk means what? Let's clarify it. Market risk means what? Price change due to rate, forex and indices. But liquidity risk is what? You can't sell what you want at the price you expect. That is called liquidity risk. Means suppose you expected some price, you are not able to sell that at that price, and also you're not able to sell what you want to sell. That is called liquidity risk. Often they interact, especially in the volatile market. Market risk and liquidity risk, they interact, right? It is like trying to sell a car during a storm. Suppose a storm has hit your city and you are trying to sell a car. Bad timing leads to bad price, right? So that is called interaction between market risk versus market liquidity risk. Then we have, we are talking about market liquidity risk here. We are not able to sell something, right? Then we have emerging market, a special case. Here you can see. So friends, emerging market are particularly vulnerable. They often face high liquidity risk, meaning the price you get does not reflect the asset fair value. That gap can cost trader heavily. So to wrap it up, trading liquidity, we are talking about trading liquidity. Trading liquidity is not just about being able to trade, right? It's about trading smoothly, fairly, safely, and when liquidity vanishes, the risk will skyrocket. That is what the main gist of this particular topic. Friends, if you want such kind of videos, right, where each and every concept is explained using this kind of flowchart, mind map, so that you can easily revise, you can devote 80% of the time to understanding, right, to basically numerical solving, and just 20% to the understanding. You can enroll in our crash course. The detail of crash course is provided in the description section. You can WhatsApp me on the number 8292857381. The same number is provided in the description section of the video for more detail regarding the crash course. Now friends, let's switch our focus to the market risk management. Who does what? So let's decode an important concept that is called market risk management and responsibility with a super clear breakdown of the key player involved. So the first player is the board of director. Basically, they are at the top of the pyramid. Their job is to set the tone for the risk. They define policies, they set the risk limit, they review, they audit regularly, they control risk related to the liquidity, interest rate, foreign exchange and equity. So these are called the board of director. So they act like a guiding hand for the risk governance. The second on the list we have, is called the risk management committee. Here you can see RMC. So they think of them like, enforcer of the rule. So whatever rule board of director has created, this is enforced using risk management committee. So they ensure that guidelines are followed. They ensure policy adherence. They monitor the prudential limit. They validate the risk model, and they handle the risk staffing. They make sure that risk is not just written down but actually managed. Then we have the ALCO. ALCO, here you can see ALCO, Asset Liability Committee. The question was asked regarding the ALCO, functions of ALCO. They are the real strategists, right? They connect business goal with the risk control, right? They connect the business goal with the risk control. They protect net interest margin, right? They manage asset liability management and interest rate views. They control liquidity and the funding policy. They oversee transfer pricing and balance sheet. They set the operational limit. These are the role of ALCO. Right, they juggle risk and return daily. Then we have ALM. Here you can see the ALM, Asset Liability Support Group. So they are the analysts behind the scene. They track the risk profile, they report to ALCO, they run simulation, they suggest action versus scenario analysis. You can think of them as team running what if scenario to prepare for anything. Then we have the middle office. So the gatekeeper of the control and transparency, they are called the middle office. So they oversee the treasury risk, they independently monitor and report, they report to ALCO, they validate pricing, they separate from front office to avoid conflict. So they bring balance between trading and oversight. So again, I'm repeating, basically market risk is not managed by one person. It is a collaborative structure involving a strategy, monitoring, policy. So board of director define the policy, risk management committee, they enforce them, right? They bring into practice. ALCO, you can call ALCO like real strategist. They connect business goal with risk control. ALM support group, here you can see ALM support group, they are the analysts behind the scene. They report to ALCO, run simulation, and middle, they are gatekeeper of control and transparency. They oversee the treasury risk, report to ALCO. So everybody has to report to ALCO, whether it is ALM support group or it is middle office. They have to report to the asset liability committee, right? So friends, each unit has a defined role, and together they protect the bank from unexpected market shock. Now let's come back to this particular slide. Every aspect from where question have been appeared in the previous 2 to 3 or 4 examination have been covered in this particular slide. Now there is a very important thing which is called BPV. So ever wondered how sensitive bonds are to the interest rate change? Have you ever thought about it? Today we are talking about one of the most important tool in the market risk measurement, that is called bond price value or BPV. So what is BPV? Here you can understand. See, BPV tells us how much the price of a bond change when the interest rate change by just 1 basis point. Try to understand. Interest rate is changing by 1 basis point, that is 0.01%. How much will the bond price will change? So basically, one basic price change in the yield is equal to bond price change. Two things are there. On one side we have the yield, that is the interest rate. On the other side we have the price of the bond. So 1 BP change in the yield is equal to bond price change. So higher BPV, it means higher interest rate risk. So BPV, you know, is a direct tool to use to assess the market risk. Simple but powerful. Now how to calculate? Let's understand with a quick calculation. So we are given a 5-year bond, right? 6% coupon, semi-annual return. Yield goes from 8% to 7.95%. Price go from, obviously yield decreases, so price increases. Price grow from 92 to 92.1.0. So what is happening here? That price increase 0.10 for 5 BPS. So 0.02 per BPS. So this give us BPV of 2000 per 1 crore face. Just multiply by 1 crore on both the side, rupees 2000. Right. So now suppose what happened, that now imagine 8% BP drop in the yield. So the basic formula is that gain or loss is equal to BPV multiplied by yield change, because BPV relate two things it relate. On one side we have the price, on the other side we have the yield change. Now what is happening here? Suppose yield 8%, 8 BP drop. So what will happen to the profit? Ultimately it will increase by 16,000 rupees per 1 crore. Right. So for rupees 10 lakh holding, the profit you make is 1600. Not bad, right? So that is the effect. So first of all, you find the BPV, and using BPV you can analyze what will be the effect on the gain or loss for a certain yield change. Then look at the maturity effect. Longer the bond maturity, higher the BPV. Remember it. Longer the bond maturity, higher the BPV. At the bond near maturity, BPV gradually fall. At maturity, BPV is equal to 0. This is very important thing, right? In your book, it is written, and you can simply see the summary fact. That is why it's called crash course, because we don't cover everything. We cover only those things which are mattered from examination point of view in this particular crash course. If you have not seen the earlier videos, I request you to please go through them. So maturity effect means what? Longer the bond maturity, higher the BPV. As bond near maturity, BPV gradually fall. At maturity, BPV is equal to 0. So BPV help us in understanding risk, planning hedge, and making a smart investment call. If you found this breakdown helpful, don't forget to like, share and follow. Now move to the next slide. Understanding bond duration and sensitivity. So using this slide, you will understand every aspect of it, and this will really help you in your final revision purpose. So friends, it was developed by Frederick McCullough in 1938, as you can see. This tells us the average time to receive the present value of all the future cash flow of the bond. That means how much average time to receive the present value of all the cash flow. You can think of, cash flow gravity center. It tells us how sensitive a bond price is to the change in interest rate. Right. So duration tells us how sensitive a bond price is to the change in interest rate. Right. In the previous case, BPV, we have seen yield versus price. Here, interest rate versus price. So longer duration, it means more interest rate risk. Let's take an example. Suppose we have a 3-year 100 rupees bond, 8% annual coupon. So yield is how much? 8%. If we calculate the present value of each year payment and multiply it by time, so we get cumulative PV, right? So which is equal to 278.34, and divided by the bond price, this will give us 2.7834. That is around 2 year, 9 month and 12 day. So just you have to remember the formula, summation of PV into T upon summation of PV. That will give you the duration, right? So McCullough duration is 2 year, 9 month, 12 days. It's like saying the bond act like a single payment made after 2.78 year. And yes, higher the duration, higher the sensitivity to the interest rate movement. Right. So it's like saying that this particular case, right, it's just like single payment after 2.78 year. What is the modified duration? So while McCullough duration tells us the timing, modified duration tells us the price change for 1% movement in the yield. McCullough duration, what it is? It tells you time. That this entire bond cash flow, we can simulate it like one single cash flow which I will receive after 2.78 year. The same amount, right? Now what is modified duration? It tells us how much the price will change, bond price will change for 1% movement in the yield. So the formula is McCullough duration divided by 1 plus yield. So with McCullough duration, suppose 2.7834, yield is 8%. We can find the modified duration by dividing 2.7834 by 1 plus 0.08, which is equal to 2.57. So suppose interest rate fall by 1%. So the bond price rise by rupees 2.57 per rupees 100. Then we have the price sensitivity. So if you want to estimate the price change without detailed calculation, you can, here is a shortcut. Approximate percentage change in price is equal to negative of modified duration multiplied by yield change. So suppose yield drop by 1%. So price will increase. That's why negative sign is put there. So what is the percentage change in price? Multiply minus 2.57 with minus 1%, because yield change by 1%. This will give you the new price change, which is 2.57%, and new price is 102.57. So to wrap it up, we have discussed the three duration: McLeod duration, average timing of cash flow; modified duration, price sensitivity to interest rate; and price sensitivity, quick price change formula. Now friends, let's look at the VAR, value at risk, very important aspect from where question are asked. Try to understand every aspect of it. So friends, VAR is like, risk thermometer. It tells us the maximum expected loss, right? So here you can see the concept. It tells us that how much maximum you can expect to loss under normal market condition over a fixed time frame and with certain level of confidence. Three things are there. First thing, worst to expect maximum expected loss. Second thing, normal market condition. Third thing, fixed time frame. Fourth thing, certain confidence level, right? Now key points is that if you are holding over a long time, right? If suppose you are holding for a long time, right, then your VAR will be higher. And if you are holding and you have a high confidence into, see, first thing is the timing, right? That means fixed time horizon, you see. So if you are holding for a long time, VAR will be higher. If your confidence level is higher, VAR will be higher. It is used to assess both individual security as well as the entire portfolio, right? You can go forward for individual security as well as the entire portfolio, right? But here is a twist. VAR, is a statistical estimate, right? Not a crystal ball. It don't predict extreme market crash, just regular fluctuation. So let's give you a real world example. Here you can see one day VAR, right? Let's say you are managing a 10 crore portfolio. Your one day VAR at 99% confidence level is rupees 10 lakh. Fine. What does that mean? This means that 99% of the day your loss won't exceed rupees 10 lakh. But on that 1% of the day, around 2 to 3 times a year, the loss might be higher. That is your risk window. So whenever I say that your one day VAR is rupees 10 crore, one day VAR is rupees, suppose you are managing a 10 crore portfolio, or suppose your one day VAR is rupees 10 crore at 99% confidence level, it means 99% of the time your loss won't exceed this 10 lakh or 10 crore. But on one day, 1% of the time, that is 2 to 3 times a year, the loss might be higher. Now if you look at the VAR model, so here you can see VAR model. Let me take you through that. So there are three main model. Here you can see. Okay, we will talk about the method in the next slide. Now volatility, right? Let's talk about this volatility. What is the volatility? This is the key ingredient, of VAR. Let's not forget that VAR is all about the volatility, right? So yield volatility. What is the meaning of yield volatility? So it measures the variation in the yield. It is independent of time or duration. Here time is nothing. Time is not taken into consideration, like we did in the McLeod duration. Here time has no role to play. But it measures the yield variation in the yield, and there is something called price volatility. It measures how a bond price can change, but it depends on time duration, but not that much on yield. And the connection between them is price volatility is equal to yield volatility multiplied by BVV into yield upon price. This is a very important formula. This is your formula for understanding how interest rate movement affect the bond price. Because price volatility depends less on yield, it depends more on the time duration. Then we have important reminder, important notes. Here you can see. What is the important notes? That VAR is powerful but not perfect. It is a statistical estimate. It is powerful but not perfect. It is not for predicting black swan event, right? That is the point. And one more thing I want to tell you, that some factors are there. Price or rate volatility, it asset correlation, longer time is high VAR, high confidence means high VAR, used for instrument and portfolio. But limitation, I told you, a statistical estimate, not for abnormal market. It measures market risk exposure. Now let's move over to the value at risk, some more points, right? Some more points related to the value at risk in the upcoming slide. So what are the methods to calculate the VAR? Very important thing. So friends, some important points related to calculation of VAR. The first we have is called correlation method, right? So correlation method is also called variance covariance method. This is a deterministic approach. It is based on fixed mathematical formula. It uses sensitivity analysis. It uses variance covariance metrics, right? It needs data on volatility, correlation between assets. It assumes that returns follow a normal distribution. That is called correlation metrics. Remember the keyword, deterministic approach. Sensitivity analysis, variance covariance matrix. It needs data on volatility, correlation between the asset. It is simple but assume perfect market condition, which is not ideal for unexpected event. Then we have the historical simulation. What it is? This method use actual historical market data and price movement. It is no need for variance covariance matrix or normality assumption. The advantage is that real world based, no need to assume correlation, but disadvantage is that it may miss the rare or new market event that have not occurred in the past. Then we have the Monte Carlo simulation. This is very important. This is the most advanced method. It generates thousands of random market scenario based on assumption. It requires models for volatility, correlation, and market behavior. It is computationally heavy, but offer higher flexibility and accuracy. If you look at the limitation of VAR, here you can see the limitation. So you know that VAR does not show the worst case loss, right? It is not tailored to any one specific market event. It is not sufficient on its own. It shall be supported with back testing, calibration, stress testing, and scenario analysis. It is on it is not sufficient. You have to back it up with stress testing, scenario analysis, back testing, calibration. If we see the core input which are required for VAR, the first thing, we need a holding period. That means 1 day or 10-day horizon. Confidence level, there is 95% confidence or 99% confidence. Historical data window. So model accuracy versus actual market condition. Why VAR is useful? Let's look at it. So VAR is used by bank, MNCs, fund manager, financial institution, because it converts risk into a clear loss estimate. It provides a single summary number. It helps meet regulatory risk disclosure requirement. It covers part of the modern risk management framework. And some more point you must keep in mind regarding the VAR, right? So some more formula I told you that price volatility, I told you here. Let's see the formula. Price volatility is equal to yield volatility into BPV into yield upon price. Now let's look at this particular test. What is back? You might have heard the back testing, stress testing. What it is all about? These are called risk assessment analysis. So friends, imagine you have built a fancy model that predict the risk. Great, but how do you know it actually work? That is where back testing comes into picture. It compares the model predicted risk, which is the VAR, to actually what happened in the real life. It is usually checked monthly or quarterly. So basically it compares predicted VAR versus actual over time, right? So two things can happen. If the actual outcome fall outside the expected confidence level, right? If actual outcome fall outside the expected in confidence level, there is a red flag. It means time to revisit your data, model assumption, parameter, and even the methodology. Right. So back testing is a standard practice under supervisory framework and is closely linked with the internal model approach for calculating the market risk capital. So back testing is reality check for model. Right. Suppose you have built a fancy model that predicts the risk. It compares the model predicted risk to what actually happened in life. And if the actual outcome fall outside the expected confidence level, that is a red flag. That means it is a time to revisit your data. So back testing is a standard practice under supervisory framework and is closely linked with the internal model approach. Right. Then we have the stress testing. While back testing is like checking the weather forecast accuracy, stress testing is like simulating a storm. You are simulating it, right? So you have built a model, risk prediction is there, but how good it actually works, that is called back testing. Model predicted risk to what actually happened in the real life. If the actual outcome fall the expected confidence level, that is a red flag. Right. And stress testing, what happened, it asks what if something extreme happened, can we survive it? There are two major techniques. The first is called sensitivity testing, and the second is called scenario analysis, which are the two stress testing technique. So in sensitivity testing, what happened, it look at the short term impact of changing one or two risk factor, right? And scenario analysis, this is the big picture shock. This was the real historical event like 2008 financial crisis you created, or hypothetical but plausible disaster designed to see how tough the portfolio really is. So to summarize, right, back testing means checking accuracy of risk prediction, and stress testing is prepare you for extreme unpredictable shock. Together, they are non-negotiable tool in the modern risk management. So next time someone say we are covered, ask them, have you back tested it? Have you stress tested for it? So friends, that is all you need to know for this particular topic, nothing else. If you cover this much, that is more than enough. I hope you enjoyed the session. I request you to please like it. If you want to enroll in our crash course, do see the description section of the video. Thank you.